Good morning, everyone. It's Monday, the 19th of July, and in news today, the QE fixes nothing. The weekend saw another opinion piece in mainstream media with the headline, Australia's inflation rate could skyrocket as US CPI rises. The article went on to outline much of what we have shared in previous weeks about US inflation taking off, how the US always leads and we will follow, and how that would see rates rise and our property and share markets get wobbly. Today, however, we share the other view that inflation is indeed transitory and the broader construct dis-inflationary. However, the inflation debate at higher levels of thinking rages on, and it is certainly not clear which path it will take. Last week saw the release of US bank data that shows lending has flatlined whilst deposits are spiking. All the printed money is not leading to more private debt, it seems. That's not good news for the Fed. In an excellent article by Real Investment Advice, they also point out that QE is simply not working for anyone other than the wealthy benefiting from inflated financial asset prices. Fed requires debt issuance. Of course, the Federal Reserve requires debt issuance by the government to facilitate quantitative easing. Since the financial crisis, total government intervention surpassed $43 trillion into the economy to keep it afloat. You can see that in the chart coming up. I say afloat rather than growing because since 2008, the total cumulative growth of the economy is just 3.5 trillion. In other words, for each dollar of economic growth since 2008, it required $12 of monetary stimulus. Such sounds okay until you realize it came solely from debt issuance. Government spending has a negative multiplier. Here is the problem. Excess debt has a 0 to negative multiple effect. Such was shown in a study by the Mercator Center at George Mason University by economists Jones and DeRuby. The multiplier looks at the return in economic output when the government spends $1. If the multiplier is above 1, it means that government spending draws into the private sector and generates more private consumer spending, private investment, and exports to foreign countries. If the multiplier is below 1, the government spending crowds out the private sector, hence reducing it all. The evidence suggests that the government purchases probably reduce the size of the private sector as they increase the size of the government sector. On net, incomes grow, but privately produced income shrinks. Notably, politicians spend money based on political ideologies rather than sound economic policy. Therefore, the findings should not surprise you. However, the conclusion of the study is most telling. If you think that the Federal Reserve's current monetary policy is reasonably competent, then you actually shouldn't expect the fiscal boost from all that spending to be large. In fact, it could be close to 0. This is, of course, all before taking future taxes into account. When economists like Rupert Barrow and Charles Redlich studied the multiplier, they found once you account for future taxes required to pay for the spending, the multiplier could be negative. Monetary policy in its current form is not helping the economy. As a result, the Federal Reserve has lost the ability to influence economic growth. Conclusion. The Federal Reserve has no real options unless they are willing to allow the system to reset painfully. Unfortunately, we now have a decade of experience of watching monetary experiments only succeed in creating a massive wealth gap. Most telling is the current economists' inability to realize the problem is trying to cure the debt problem with more debt. In conclusion, the Keynesian view that more money in people's pockets will drive up consumer spending, with a boost of GDP being the result, has been wrong. It hasn't happened in 40 years. The reality is that monetary policy is not expansionary but rather contradictionary. Unfortunately, deflation remains the most significant threat as permanent growth doesn't come from an artificial stimulus or debt, but such is a lesson that has yet to be learned. As a reminder of how distorted perceptions are that everything is awesome because shares are high, the following chart both clearly illustrates that narrative but also how hefty that painful reset could well be. And here's the chart coming up now. Remember, gold is driven by providing shelter to such distortions. Negative negative real rates can be derived from high inflation with normal rates, or by normal inflation, but near zero or negative rates. The market experts are torn between the transitory or sticky inflation debate. Should you own gold, you could respectfully not care. If inflation does stick, the mountain of debt, the Fed's trap, and the bond markets mean rates can't go much higher. Negative real rates. If, as the piece above predicts, we will move to a disinflationary environment, the bond market is already telling you that its choice with falling and very low yields. The Fed will either allow the painful reset, which is very unlikely, or double down on monetary stimulus. Again, negative real rates and safe haven trades and real money versus debased currency trade. Heads, you don't lose. Tails, you don't win. All right, there we go, guys. That's news for today. Hope you enjoyed it, and we will see you again tomorrow. Bye.